When tax season rolls around, many of us wonder how to make the most of our deductions and keep more of our hard-earned money. It is a big question that can really impact your finances. The tax implications of choosing to itemize your deductions versus taking the standard deduction boil down to one main goal: reducing your taxable income. You will choose the method that results in a lower tax bill, and this choice often varies from person to year. The reason this choice matters so much comes down to how each option works. The standard deduction is a fixed dollar amount set by the Internal Revenue Service based on your filing status. It is a simple, no-fuss way to reduce your taxable income without tracking specific expenses. Itemizing deductions, on the other hand, means tallying up all your eligible expenses like mortgage interest, state and local taxes, medical costs above a certain threshold, and charitable contributions. The goal is to see if these specific expenses add up to more than the standard deduction amount. After the Tax Cuts and Jobs Act of 2017, the standard deduction amounts significantly increased, which means fewer people now benefit from itemizing compared to before. So, how do you figure out which option is best for you? The first step is to gather all your potential itemized deductions for the year. This includes the interest you paid on your home mortgage, real estate taxes, and any state income taxes or sales taxes you paid up to the $10,000 limit for state and local taxes. Also consider significant unreimbursed medical expenses that exceed 7.5% of your adjusted gross income and charitable donations to qualified organizations. Once you have a total for these itemized expenses, compare it to the standard deduction amount for your filing status. If your itemized expenses are greater, then itemizing will likely save you more money. If not, the standard deduction is usually the better choice. Many tax software programs and tax professionals can guide you through this comparison effortlessly. An interesting detail is that the specific thresholds and limits for itemized deductions can change. For example, while the state and local tax deduction, often called SALT, is capped at $10,000, understanding this limit is key. Also, cash contributions to public charities typically have a 50% adjusted gross income limit, though this can vary. These details highlight why good record keeping throughout the year is invaluable. Saving receipts and statements for things like medical bills, property taxes, and charitable donations will make this decision much easier come tax time. Ultimately, understanding the difference between itemizing and taking the standard deduction empowers you to make an informed choice that optimizes your tax savings. By knowing which expenses count and keeping good records, you are better prepared to tackle tax season and ensure you are not paying more than you need to. Remember, for personalized advice, it is always a good idea to consult a qualified tax professional.